Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are talking about the theory for Chapter 9, which is on current liabilities and long-term debt. And in particular, over the last 5 videos, this will be the 6th one, we were discussing bonds. Okay, so before I get started, you know, in this particular video, we're going to be talking about adjusting entries for bonds payable, right? So I'm not going to keep on going over everything from the previous videos. Um, so go back and watch those 3 videos again if you have to, if you don't understand something, because I'm just building, cumulative knowledge here. I'm not going to keep on going over something that I discussed in a previous video. And also, the thought popped into my head that you've had this already for those students who have had math for business and finance or math applications. This topic was covered um, in that particular subject, and it was presented a little bit differently than it's being presented here in this particular textbook. So it might be worth it to go out to the student community under the uh, business group, okay, and look at the section on the left-hand side, math for business/applications, and watch the videos that apply to the bonds in that particular for that subject. So the point being here is up to this point in time, you should have all of this underlying theory, down pat, so that as we move on to adjusting entries, all I need to do is just discuss the, uh, you know, what is new. Okay, so these were the entries. Let me just erase this. This was for the premium video, discussing the premiums on bonds payable. Okay, so all right, now we're using the numbers from the textbook, all right, because like I said in the last couple of videos, they present the information as is, and I didn't think they did a decent enough job of discussing the underlying concepts to how they had gotten that information. But let's, as far as what we're going to talk about here, as far as adjusting entries for bonds payable, we're going to talk about it from the discount side. Now remember, the discount side and the premium side, they're two sides to the same coin. Okay, if you know how to do one, you know how to do the other. It's just the opposite. It's like accounts receivable and accounts payable. You debit accounts receivable, that's the normal balance for accounts receivable. You credit accounts payable, that's the normal balance for accounts payable. All right. Bonds are the same exact thing. You have a discount, you have a premium, right? Just the opposite. So the textbook uses the example of the for the adjusting entries, they're using the discount. And just to recap, there was $500,000 of bonds at 8% for 10 years. And they were selling the bonds at a discount for $478,000. Okay, so that made the discount on the bond payable, all right, $1,100. Okay, as part of the entry when they were doing the interest expense. Okay, to see that entry, remember it was on September 30th. We had a debit to interest expense for 21.1, a credit to the discount on, and I'm going to put BP for bond payable here, 1100, and a credit to cash for the 20,000. Okay, so as a quick brush up, what we're looking at here is on September 30th, the person had bought the bond, and the bond, the interest was semi-annual, and the payment was on September 30th, because the bond was bought on April 1st. 6 months later, they're cashing in one of the coupons for the interest. So they were going to receive, $20,000 of interest. If this was at par, our interest expense would have been $20,000, all right? But it isn't at par, it's at a discount. And being it's at a discount, we had to amortize the discount on the bonds payable, and that's where we had gotten the $1,100 from, okay? So with that in mind, the whole idea here is that notice that this was on September 30th, okay? This is not December 31st, all right? Basically what you're saying is that bonds, let's assuming semi-annual payment periods, bonds that are purchased on January 1st would have a payment, on 6/30 and then 12/31. Okay, 12/31 being the end of the year. Well, rarely, how many bonds are actually bought on that particular day? Okay, on January 1st, versus the rest of the year. So all during the rest of the year, what's going to happen here is you see we have the interest payment on 9/30, okay, which, because we bought it on 4/1, which you're going to pay the you're going to make this entry on 9/30, okay. Now the next one, and I'm just going to guess at the day here, 9/30, so the next one would be on like March 31st, okay. That would be your next payment. But the issue here is that we have to deal with December 31st for the year end. How do we, when we're closing out our books at year end, how do we make the, we need to make an adjusting entry for the interest on these bonds, because it's, there's an expense between September 30th and December 31st. So we have to make that adjusting entry to book our expense and for the bond payable, right? So the date is December 31st, right? Well, if you're between 9/30 and 3/31, which is 6 months, the next coupon payment, that's 6 months, and we're paying $20,000 in interest. Well, on a timeline, here's 9/30, here's 3/31, and this is 12/31, right? Well, this here is 3 months, right? And this is 3 months. So for this example, it's relatively easy because this is half, right? So we can take half of the $20,000, right? That means our entry for our interest is going to be $10,000. But realize that depending upon the dates, okay, you're going to have to calculate this time frame here, okay, and prorate everything, okay, figure out how much it is for that particular period of time. Let's say it was August 31st, okay, and so that means this would have been due on let's see, 2/28 approximately, okay. Well, how far is it from August 31st to December 31st? 4 months, okay, and this is going to be 2 months, all right. So that is going to be 4 months, right, over 6 months, because the 4 months is what we use over the 6-month period. That's going to be 2/3. We're going to take 2/3 of the $20,000, right? Whatever. Let me do a calculation here. 20,000 times 2 divided by 3. That means our interest for that period would be 13,333.33. Okay. So basically, let me erase all of that because it's getting messy, and then just recap it real quick here. Rarely do you have your interest payment occur on the last day of the year, okay? And of course, you have to, at the end of the year, you're going to have to make some type of adjusting entry. So what you need to do is you need to figure out, and using a timeline, okay, here's the beginning, and here's the, and let's call it end, all right? This here being a, whatever period that is, in this case here, we're talking 6 months, and this is 12/31. Well, you're going to have to figure out how much interest is between whatever payment date was last made all the way up to 12/31, because you have to make an adjusting entry for that amount on December 31st. Okay. If we had $20,000 of interest and it was from 8/31 to 12/31, I just showed that that would be 13,333. Okay. I mean, it's, you can't just look in the book and find it exactly. You have to work through the numbers, work through the concept. Okay. In our particular instance here, we have, from 9/30, and our next interest payment would be on 3/31. Well, on 12/31, this here period is 3 months, or 1/2, right? 3 months over the 6-month interest period is equal to 1/2. That's 1/2 of the interest payment that we're going to have to book. So if it's $20,000, half of $20,000 is $10,000, right? So that's the math behind getting the amount of the interest. And we can't, we know that we're going to have to deal with $10,000. Okay, that is not our interest expense. Okay, because we also have to take into consideration the discount, right? So, and we're also not paying it out. All right. So if we have this $10,000 of interest that's accrued from 9/31 to 12/31, that becomes a credit to interest payable for $10,000. Now, that's our interest, and we have to do the same thing for our discount on the bond payable. Our discount on the bond payable is $1,100. Well, half of $1,100 is $550. Okay, and so that would be a credit to the discount on the bond payable. Okay, BP for bond payable, and that means debits have to equal credits. So I'm going to book my interest for December 31st. My interest expense is going to be the total of those two, or $10,550. Okay, so that's my journal entry that I'm making on December 31st in order to accrue the interest payable and to be able to expense the interest expense as of December 31st. Okay. Now, just to kind of like get this a little bit clearer in your mind, I'm going to draw a long timeline here, and this we're calling 9/30 because this was our first interest payment. Remember, we bought the bond on 4/1, so our first interest payment happens on 9/30. Then we have 3 months go by to 12/31. Okay, and we're going to have to make an adjusting entry on 12/31 because our next interest payment is on 3/31. Okay. Now, what we've done is we have to make the adjusting entry here, which is what we just did here, in order to adjust for the year end. The next entry I'm going to show is going to be for this period of time, okay, between the year end and when our next interest payment is going to occur, right? But I want you to realize that 6 months later, all right, which would be 9/30 when our next interest payment's going to be, okay, well, that would be the same exact journal entry that you had here, okay? Right. So, you know, depending upon where you're at in the cycle, all right, you're going to be making, you know, either this entry here, all right, and or, well, let me say, and this entry here, but we also have this entry to take into consideration, which I'm going to show you now. I know this. I'm having a difficult time expressing this this idea, because when I keep on thinking back to the discount and the premium, where, okay, yeah, if I just paid the interest on 9/30 or 3/31, you're going to be making this entry here, okay, which is correct, but only when we're making this entry for 9/31, okay, because that represents a full 6-month period, okay. But that isn't the case for, you know, each and every interest period, okay. Month, why did I write month? Okay, so that entry here, okay, is the entry that we would be making here, all right. But we know that we can't make that same exact entry when it comes to a year end, okay? Because if we made that entry here on 9/30, okay, now when we come to 12/31, right, we can't make that same entry. We have to make this entry here, okay? So this entry is going to be here, right? But now that, by making that entry, because we're, you know, accruing that interest payable and expensing only for a 3-month period, we have to consider that for that those next 3 months here, we have to make, or actually I should have done that black. We have to make this entry here, which is the next entry I'm going to show you. So you see the cycle. Here's this one entry here. This is number 2, which is going to be the entry I'm going to show you in just a bit, and this is going to be entry number 3, which is here. And then you're going to go through that same cycle again. Here's entry 1, here's entry 2, and you're going to make, here's entry 3 as this goes out to 9/30, right? So it's going to be a revolving set of journal entries that you're going to make. Now, I showed you entry 1 and entry 2, so I'm sorry, entry 1 and entry 3. So now let me show you entry 2, and then everything can get tied all together here. I hope I'm not making everything more confusing. So this here was entry 1, this here was entry 3. So now let's make the entry for March, whoops, I want green, I don't want gray. So March 31st, right? So on March 31st, remember this is also for a 3-month period, right? Just like this here was a 3-month period, half of this, right? So on March 31st, the person's going to come in and they're going to want their cash for the interest. So yeah, we have to credit our cash for the $20,000 that we're going to pay them out, okay? We also have to book our premium, I'm sorry, our discount on the bond payable. So that's a credit to the discount on BP stands for bonds payable there, of the 550. Remember, that's, again, the half of this, which is the same half of this, right? We have to debit our interest payable for the $10,000, okay? Remember, that's half of this is the same half of that, right? And then we have to debit our interest expense. Now we can just basically do the math and back into our interest expense. Add up our debits, add up our credits, subtract one from the other, and we end up with 10,550 is what our interest expense would be for that accounting period, right? I'm sorry, for that adjusting entry. But realize that that 10,550 is half of that, and there's the other half. Okay, so remember, this here is for the 6 months. This is the entry the normal entry you would make when you, let me erase this. This would be the entry you make right here when you have an interest payment that is for the entire 6 months. Okay, and again, this is on using a discount. A premium would be just the opposite. Go back and watch the premium video to see, or look in your book to see what that entry looks like. Okay. However, rarely does the interest period end on December 31st. Okay. And because December 31st, we close out the books for the year end, we have to make some type of adjusting entry. So what you have to do is you have to figure out, this is 12/31, you have to figure out two different entries, okay, and prorate it, okay. When from the last time you made a payment, all right, which was 9/30, whatever period time frame, however long that is, you have to prorate it against the entire 6 months. Okay, so if that was a 3-month period, 3/6. If this was August 31st instead, well, that's 4 months, so it would be 4/6. So I take 2/3 of this entry and make that journal entry right there. I mean, if this was 7/31 or 7/30, whatever it is, right, that would be 5/6. So I take 5/6 of this entry and make it for that adjusting entry at the end of December. And of course, because of that, the remaining time frame is where you have you make that adjusting entry here, and then when you get to when you actually have to make the payment, you're going to pay out the cash, okay, but you have to book the remaining portion of that interest payment so that your books stay in balance. So it's the full 6-month period. So if this here is 3 months, this is 3 months. If this was 2 months, well, then this would be 4 months. Okay, and you have to prorate, figure out those numbers for yourself. Okay, you're not going to be able to just look in the book. Okay, because if you looked in the book and you see it here, you would have without thinking, you would say to yourself, okay, I have to make half. Right? Well, it's only half because the date when we make that interest payment is 9/30, which is 3 months from December. I know I'm harping on that, but I can't stress it enough that you can't just, the process, the thinking behind it is relatively easy. I mean, you saw me, go through this with a 3-month, but just realize that you can't just automatically think it's half and half. Okay, it's 3 months and 3 months. You have to actually look at the dates and figure out the time frame up to making that adjusting journal entry. Okay, and that's whatever prorated amounts they are. That's what you're making that journal entry for. And then from the period after December 31st to the next payment, that's the remaining portion of that prorated 6-month period. Okay. All right. I hope that made sense. Definitely pause the video, go back and watch it again. You know, try to read through the book. And even though the book gives an example for a 3-month period on a discount, the numbers work out. But I just want you to realize that you have to really create a timeline and see where you're at on the timeline, and then prorate that 6-month interest payment, so that prorate it to the adjusting entry for December 31st. Right? And if you still don't understand it, feel free to telephone and speak to an instructor, and we'll try to present it in some other fashion so that it becomes a little bit easier for you to understand. All right. So with that, that's all you need to know about bonds. Go back and watch the videos again. Don't understand something, call and speak with an instructor. And in the next video, we're going to go on to new subject matter, which would be lease liabilities, I believe. All right, so I'll see you then.